Hello and welcome to a brand new episode of ET Markets PMS Talk, a show where we discuss the opportunities as well as investment strategies deployed by the fund managers in the popular space of ultra HNI investing. Well, my name is Shatajanand, and today we have with us a very special guest, Sachin Shah, who is the fund manager at Emkay Investment Managers Limited, who manages over 600 crores in AUM. Welcome to the show, Sachin.
Thank you, Kshitij. Thank you so much for having me. It's always a pleasure and privilege to be with you guys.
Thank you so much for your time, Sachin. Now, let me quickly come to the funds that you manage. So you handle over 600 crores in AUM. The Capital Builder Fund has given a CAGR of 14% in the last 10 years. So what was your strategy?
Yeah, so Kshitij, you're right. This 31st March 2023, I completed managing 10 years of Emkay Capital Builder PMS.
Wow.
And over this 10 years, we have nearly quadrupled, which is like 3.84x for the investors, delivering 14.4% compounded annual growth rate, which is we have outperformed both the Nifty 50 and the Nifty 500.
Absolutely.
We delivered nearly 38% higher returns over Nifty 50 and about 24% higher returns over Nifty 500. In terms of our strategy, I think from the very beginning, we have been playing on the game of power of compounding. The entire portfolio construct over the last 10 years has been in that direction. And let me back this up with some data points, right?
Sure.
So like say and this is like a 10-year track record. So like say for example, first point, more than 90% of the capital gains that we have booked or even currently which is sitting on our portfolios are long-term capital gains, which is we would have owned this for more than 1 year, 2 years, 3 years. Our portfolio turnover ratio is just about under 20%, whereas if you look at the average mutual fund industry equity schemes, turnovers will be in the range of 70 to 85%. But to my mind, the most important and the proof of the pudding is that in our current portfolio holdings, nearly 45% of the portfolio value has more than 7 years plus of vintage. The next 35 to 37% of the portfolio has a vintage of 3 to 6 plus years. So one can imagine that how long we've been holding these businesses or the stocks. Since 80% plus of our portfolio has a vintage of nearly 3 to 8 years. And therefore, I strongly believe this is the true strategy and the winning factor for us.
No, absolutely. It's been impressive performance and a decade in the fund.
Yeah, so the most important thing is, we strongly believe that, the eighth wonder of the world, as Einstein probably mentioned, the compound interest, right? Compound interest is the eighth wonder of the world. Who understands it earns it, and who doesn't will always pay for it. And when this actually gets truly reflected when you look at the total returns, right? Like if you see our portfolio has delivered 14.4% return versus Nifty has delivered 11.8, Nifty 500 would have delivered about 12.6%. But when you look at the total returns over this 10 years, so like the MK Capital Builder has delivered about 283% returns. The Nifty is about 205% and Nifty 500 about 228. So that's where I was saying that we've nearly quadrupled the money, whereas in Nifty you would do about 3x kind of money.
Right. No, absolutely impressive performance on all counts. Now, let me also quickly move on to my next question. No, you have clocked over 10% outperformance over the benchmark Nifty 500 index. Now, consistent performance also leads to compounding if investors stay with the fund for that long. Now, tell us more about the eighth wonder of the world, in the real life scenario.
So frankly, whatever I just mentioned earlier has been a real life journey and experience over the last 10 years. But, let me just give you, some more examples, right? So for example, the financial year 23, which is when we had a very significant amount of outperformance, just that last 1 year. And one of the most gratifying part for us has been that the top performer in the Nifty 500 index was APAR Industries, which delivered nearly 285%. And APAR has been one of our key holdings for the last 4 to 5 years now. Right? So this once again, reimposes our faith in our investment process of believing in quality management, which is again backed by our proprietary module called Equal, and also following a disciplined approach of staying invested in quality businesses for the power of compounding to play out. The other big alpha generator for us in FY23 has been ICICI Bank, right?
Okay.
This was also up 20% in FY23 when the markets were literally flat. So for a large cap Nifty stock, delivering 20% is a very big outperforming stock. And even if you look at the last 1, 2, 3, 5 years, it's been the best performing large private sector bank. We've been owning ICICI Bank for probably now 6, 7, 8 years, right? We also own quite a few other stocks for the last 5 to 7 years. Say like DV's Labs, Sundaram Fasteners, HDFC Bank, Nesco, Mahindra Holidays, right? And we've owned this stock through the thick and thin of time, right? During good patches, bad patches, because we strongly believe that there will be business cycles where there will be good patches and bad patches, but that doesn't make a good company a bad company. And in most cases, even the vice versa is, is applicable. So that really is our mantra, that as long as the companies and managements are not treading away from the paths, right? And they are very focused on doing the right things for all the stakeholders, just be with them. And the eighth wonder of the world, the power of compounding will actually kick into your portfolio.
Absolutely. In fact, delivering this kind of outperformance for the last 10 years also mean that you will have robust risk management practices. Now, take us through that as well.
Yeah, Kshitij. So, actually, I strongly believe that the risk management has to be implemented right at the beginning, right? It has to start
from the stock selection.
Yeah, when you start actually investing, right? It is at the start, at the time of when you are buying, purchasing of your securities, when you're constructing your portfolio. That is when actually your risk management has to begin. And I have also experienced over these years that majority of the bad investments will be linked to either one or two of the classic errors, Like the first is the error of quality, right? Where we talk about the poor, low integrity, low capability kind of managements. And the second big error has always been the error of valuations, where we always have the wrong purchase price, where we are buying very high valuations. We get carried away during the euphoria kind of scenarios. So these are two classic errors that one as an investor generally tends to do. One is the error of quality, and the second is the error of valuations. There can also be another, from a portfolio perspective, there's also another third possibility, which is the allocation risk, right? When we do some lopsided allocations to a particular security or a sector. Like, for example, I know many portfolios during the heydays of 2000 were like 70-80% into IT sector. Now that in those days they were doing exceedingly well, but when there were headwinds for the sector, they had serious troubles, there were liquidity issues. So, these are some of the processes that we have always put in place. Over these 11 years, we said that we at least want to avoid this kind of blunders, right? And we've been following it very religiously. Like, we created our own proprietary module called Equal. This module actually helps us in very objectively evaluating the management quality with all the publicly available data points. So this at least helps us in avoiding the first error, which is the error of quality. Then our Equal model is also embedded with a risk reward matrix, which helps us in understanding a good purchase price. So again, helping us avoiding the error of valuations. And then third, we have allocation disciplines in place as a part of our investment process. So like, no single stock will be more than 7.5 to 10% if it's large cap, not more than 5 to 7.5% if it's mid cap, not more than 2.5 to 5% if it's a small cap. No single sector will be more than 15 to 20%, unless there's a large BFSI which has a very heavy weight in index, which is 40%. But even there, we are fairly cautious. Generally, we don't go beyond 25 to 30%. So we have this allocation disciplines in place, to avoid any kind of concentration risks.
Absolutely. In fact, so Equal would be the methodology how you pick stocks for the portfolio?
Yes. So Equal definitely is one of our, I would say, foundations.
Okay.
And equal as a model basically has some 30-40 odd parameters, and for each parameter we will have a range of scores, right?
Okay.
And depending on the aggregate score that we would get for each of the companies, this entire investment framework is based on that. Over and above this, within the equal, we also have some red flag parameters, so which will override the total aggregate score also, because even if one of them gets ticked in, then we generally avoid investing in those businesses. Red flag parameters like promoter holding pledged is very high, or if there's a large acquisition. What is a large acquisition? If it's more than 50% of your balance sheet size, then those kind of things we generally try to avoid investing, at least for some time, and then we see how it's playing out. There are also other various fundamental parameters, right? Say for example, we look at the track record. In terms of within the track record, we are more focused on the cash flows, then we look at the balance sheet, then we look at the P&L. After that, we look at the business opportunity, because we strongly believe Indian economy is about growth. Indian stock markets respect the most where there is growth. So to understand the scale, to understand the longevity of the growth, to understand the industry structure is also very important, to understand how good the growth opportunity is going to be for the businesses that we invest in. The inherent profitability of those businesses, the ROCs and ROEs, because I strongly believe these are actually the fuel for growth. We all like growth, but for the growth to happen, we need to also invest in businesses. And now to invest in businesses, can you generate that kind of cash flows from your existing business, or do you need to borrow? Do you need to dilute equity? So if you can do it from internal accruals, that's where the inherent profitability is your fuel for the future growth, right? Then of course the management is ultimate paramount to my mind, the management quality, which is where we talk about the integrity, the strategy, the execution, and then of course the purchase price. So these are, it's a long process, but I've tried to,
absolutely. In fact, a lot of our viewers will be watching this interview, and if they are DIY type of investors, I think they should take a note of some of the parameters you've just highlighted. It will take them in spotting the right companies. So that's a very you've explained everything in a very lucid manner, so thank you so much for that. Now apart from that, let me also come to some of the winning stocks or the winning picks that you have in the fund, although you just touched upon apart industries. So how should one spot emerging multibaggers?
Yeah, Kshitij, so actually in the last 10 years, right, we've had many companies in our portfolios like ICICI Bank, Divi's Lab, Sundaram Fasteners, HDFC Bank, which have delivered some of the best returns during our long holding periods, right? But I think the key point is not only spotting them, but holding on to them when they are hit by external challenges, or sometimes even internal challenges, right? Like say for example, ICICI Bank, right? It had a long patch of NPA declarations, long patch of write-offs, and eventually it got accompanied with the challenges at the top leadership level, right?
True,
but
absolutely.
But it was actually during those times that we were focused on the company's overall other parameters, like the CASA growth, the capital adequacy, the credit growth in the retail, etc. Right? The 5 C's that they had actually talked about, and they were absolutely on track. Over that 7-8 years, ICICI Bank had a CASA of under 25%, which went to as high as 46-47%. It became the industry leader in CASA. So that's the kind of the franchisee unleashed that they did over that period. And today we are reaping the fruits of that as a bank, as investors, as all the stakeholders, right? So like another example, Divi's Lab. Again, one of the best managements that we know over the last 20 years that it has been listed for in the CDMO space, in the CRAM space, right? But even that company had a US FDA challenge in the year, I think 2016, 2017, right? And it was during those times that our conviction in the management quality was actually tested. And we did not only hold on to the company to reap the extraordinary benefits, once the management stand was vindicated, but also we had actually added some more to our positions, because we believe that is the market gives us those opportunities during these volatile phases within the quality businesses. That's where our entire research actually comes into play.
Absolutely. Now, also in the meantime, let me also quickly go on to my next question, which is about MK Gems. So what makes you positive on auto financials as well as IT, where you've allocated actually double-digit stake in this at this point in time?
Yeah. So, actually, MK James is a very uniquely curated portfolio strategy
Right.
from our investment universe. It's basically, we picked about 20 odd businesses from the universe of 150 mid cap stocks, right?
Okay.
If you go by the SEBI definition, the ranking from 101 to 250, the 150 stocks are the mid cap stocks. From that, we select 20 quality businesses, and we of course have all these internal factors that I just mentioned earlier in terms of filtering the 130 stocks out of the way, and and since we want to have compounders, right, the allocations to the secular growth sectors like your autos, the financials, the IT sector will always have higher allocations, because if you look at the history compared to the commodity businesses, compared to some of the deep cyclical businesses, the sectors like the autos and the finance and the IT and the FMCGs and the pharmas generally tend to have higher compounding stories.
Right. Now, let me also come to the final question. Small caps dominate MK Pearl portfolio. Now, what is your view on the small and the mid cap space, especially for the current financial year?
MK Pearls also has a 11-year plus track record over here.
Right.
And over there, we have actually delivered nearly 18% plus compounded returns, and once again beating the benchmarks with a decent margin, I would say.
True.
And actually, MK Pearls is a mid-cap, small-cap portfolio, right? So if you think about it, India is actually a land of entrepreneurs, right? And therefore, there will always be plenty of opportunities on a bottoms-up investing, right? In fact, our endeavor has always been here to invest in small-cap companies, which over a period of time, with power of compounding, become mid-caps, and if we are lucky in our lifetime, they also become large caps, right?
Yeah.
And we've had a few experiences like that, right? Like, for example, when we invested in a company like Sundaram Fasteners in 2015-16, it was just about maybe 3,000 odd crore market cap. Today, it's already become a 20,000 plus crore market cap. So it's clearly in that mid cap category, right? Apar Industries, again, when we invested, was just about less than 3,000. Sub 3,000 crore kind of market cap. Today it's closer to about 14,000-15,000. Now it's getting on that fringe of that small cap to mid caps.
Right.
Laurus Labs, which has been one of our biggest wealth creators in the last 5-6 years for us. We invested when the market cap was 3,000 crores. In the peak, Laurus Labs actually went to 35,000 crores of market cap. Even today, because they've had some headwinds in the business, which we believe are cyclical and not structural. Again, even today, it is still 15,000-17,000 crore market cap. So again, very, very sharp re-rating. Another very good investor was Tata Elxsi. Yes. Again, this company from a small cap to mid cap, right? So we've had a few, and that is our endeavor, that be with the businesses where you believe the longevity of the growth is there, and this is again coming to my original point of the opportunity. And as long as the quality businesses, quality management, inherent profitability is there, over a period of time, this is what happens. Another very important thing over here is that when you invest in businesses which are small caps, and when they actually move into these mid caps, and then hopefully they get into the large cap, we not only get the earnings growth, but we also get some benefit of the P re-ratings, the valuation ratings, and that is where the wealth creation actually happens.
No, absolutely. In fact, you've touched upon crucial points, especially whenever someone is building a portfolio, and impressive performance on all counts there, Sachin. We wish you all the very best for future endeavors, and thank you so much for your time. And that's all for now, but do stay logged on to etmarkets.com for more on news, business and economy. Again, thank you so much for your time, Sachin.
Thank you, Kshitij. Thank you so much.